Hello friends, in our previous lecture we have completed a theory chapter named Provisions and Reserves. Now we are going for the next important chapter of the account, that is Bills of Exchange. Some part of it we have learned in Journal Proper chapter also. If you remember, then in Journal Proper chapter, which was 8th chapter of first part, in that we have learned journal entries for drawing a bill on our debtor and accepting a bill from our creditor. If I am repeating that entry, then whenever we are drawing a bill on our debtor, then it will be receivable for us, and for debtor it will be the giver. So bills receivable account debit to debtors account, because debtors are the giver of that amount and bills is receivable for us. And in the opposite way, when we are accepting a bill written or drawn from our creditor and we are accepting it, then it is a payable for us and it is a liability. So liability will be credited and creditors are the receivers. So creditors account debit to bills payable account. That two entries we have learned, and I said that in detail about this chapter we will learn in part 2, and now this chapter is coming. This chapter has so much important concepts, but now we have to take only half chapter, because as you know the government has decreased the course. Okay, so let us start with page number 75, Bills of Exchange. Let us take some introduction from it. Generally, there are two types of financial transactions in a business, that is cash transactions and credit transactions. Cash transactions are those transactions where there is an immediate give or take of cash. Example, cash purchase transaction, cash sales transaction, etc. Credit transactions are those transactions where cash is not paid immediately, but it is payable during a specific period subject to conditions agreed at the time of transaction. Example, credit purchase transaction, credit sales transaction, etc. In such transaction, the payment of amount depends on the credit period. The credit period depends on the type of business, current situation, mutual understanding, and conditions of the opposite party and the amount of transactions. In present times, with the increase in numbers of size and the size of business, the number of credit transactions and its importance are also increasing day by day. If the payment of amount of goods given in credit is not received on time, many businessmen have to face financial problems, and it is also affected on other transactions. Hence, each businessman wishes to receive the amount of credit transaction in time. To maintain financial liquidity, normally businessman uses a document through which the person from whom the amount is receivable accepts his debt in writing and states the time of the payment of the amount, or accepts to pay the time stated in the document. If the debtor fails to pay the amount, this document can be used as written evidence for his dues. In this way, the documents which are used of two types, bills of exchange and promissory notes. In each chapter, we are reading the introduction for that thing, that what will come in this chapter. They are telling that according to the business transaction, there are two types of payment, that is cash transaction where immediate cash is taken or immediately cash is paid, credit transaction where cash is paid or received after a stipulated time. Now each debtor or each creditor thinks that their amount will be paid or received within the time. But sometimes, as you know, due to weak conditions or many problems, we cannot pay the amount in time, or we will not receive the amount in time. Now what to do? When we are not receiving on time and when we don't have any proof, then we cannot say that now you give us our amount, we are receiving it, or we are having a problem. So at that time, if we prepare a written evidence, then it would be a pressure for other person to pay the amount on time, and for that two instruments are used, as they are writing, bills of exchange and promissory note. Okay, so now meaning and definition of bills of exchange we are seeing. The definition of bills of exchange as per Indian Negotiable Instrument Act 1881 is as follows. A bill of exchange is an instrument in writing containing an unconditional order signed by the drawer directing a certain person to pay a certain sum of money only at a specified time to a certain person or according to his order or the holder of the instrument. Now take this definition as important in exam. Definitely this definition will be asked. Now again we will repeat what they are writing slowly, understanding each thing. A bill of exchange is an instrument in writing, means this bill of exchange or these bills will be in writing containing an unconditional order. It will have some order, but that will be unconditional. Why? We cannot give a condition that you pay us the amount on this condition or that condition. Here order will be there, but it would be unconditional. Signed by the drawer. Those who are preparing the bill will be signing the bill, directing a certain person to pay certain sum of money. We are directing or we are showing a particular person to pay the amount on particular time only at a particular sum of money at a specified time to a certain person or according to his order. Why to a certain person or according to order? Suppose I have to receive the amount from you people, so I will write a bill of exchange on you, means I am the drawer of the bill, you are acceptor of the bill. So I will give an unconditional order to you that you have to pay the amount to me at this specific time, at this specific period, to me or to other person to whom I say, because I have to receive from you, also I have to pay to someone. So if I directly give an order to you that you pay my amount to that person, not to me, then that is also possible here. If you are not understanding, I will give some example. See, if there are three persons A, B and C, then I am B. Okay, I am in the between, I am B. I have to receive the amount from you, so you all are person B, and I have to pay the amount to C. So I will give order to A that you pay my amount to C, so that our settlement will be over and our settlement between A and B will be over and B and C will be over. How? See, first I will receive from A, means I will receive from you, then I will receive the money, keep with me, and again I am going to pay to C. Now this is somewhat lengthy procedure, so instead what I will say, I will order to you that this is the time to pay the money. Now don't pay to me, directly pay to C, so that our settlement is over and settlement between me and C, means B and C will also be over. So this is the thing in the bill. Okay, according to the order or to the holder of the instrument. Bills of exchange is also called letter of exchange. Characteristics, simply we are reading the headings, in detail it is not required. Okay, what are the characteristics? It is in writing, it is containing an unconditional order, then it is for a specific person, bill acceptor and amount receiver, then order for the payment. Here we can give the order, but that order will be unconditional. Here amount is fixed, definite amount, date is clear, definite duration is given, signature of the person is also done, a revenue stamp is done for what? See, revenue stamp when we are keeping on the bill, then that bill becomes a registered bill, not unregistered or not a fake bill. To show that this bill is a true, we have to keep a revenue stamp, and we cannot keep, we have to assist one person who is a lawyer. On demand or at a specified time, and acceptance of the bill. Okay, now next topic is given about different parties in bills of exchange. How much parties will be there? There are three parties in bills of exchange. One is the drawer of the bill, generally he is the creditor or the trader selling the goods. Acceptor of the bill, generally he is the debtor or the customer purchasing the good. And pay, generally he is the drawer of the bill or the person who is going to receive the money or the person who is holding the bill. Means here also we have kept an example for three persons, that three persons are here also. In some situation, when the drawer and the payee both are same, then there are only two parties. Sometimes this C is not there, then two parties also can be there. Drawer, payee, holder and acceptor of the bill. Normally, bill is drawn by creditor on his debtor, which is accepted by debtor and returned to his creditor. Okay. Now a specimen for bills of exchange is given for our information. It will not be asked in exam that you draw a bill of exchange. Okay. See, 10,000 rupees is given. Then on opposite side, Military Society, Naranpura, Ahmedabad, 13, date 9/8/2016. So date is given, name is given. For the value received by you, pay rupees 10,000 only to Ritesh or as per the order after 3 months from today. To Sri Dhaval, Sargam Flats, Jodhpur, Ahmedabad. Dhaval, signature of acceptor. Kavesh, signature of drawer, and a revenue stamp is there. Okay. Now, on next page, meaning and definition of a promissory note. Now, what is this promissory note? We will try to understand. Generally, a creditor draws a bill on his debtor for receiving his dues. Along with the bill, another document is also used for setting the accounts. This document is known as a promissory note. In a promissory note, a person who has to pay an amount to another person himself gives a written promise to pay the amount. This means a debtor himself gives a written promise to the creditor to pay amount. This promise or document is known as a promissory note. See, bill of exchange is prepared by a person who is receiver of them, but promissory note is prepared by a person who have to pay the amount. So directly he is giving an assurance to himself and to the opposite party also that after a specified time I will give the amount to you. So here he is only giving his assurance, while in bills of exchange a debtor or a creditor is writing the document, debtor is accepting, and then their unconditional order is done that after this time you pay the amount. But in promissory note, directly the person who has to pay the amount will prepare that document. Now exact definition is given, you have to tick mark that. A promissory note is an instrument in writing containing an unconditional order undertaking signed by the drawer to pay a certain sum of money only at a specified time to a certain person or according to the order or the holder of the document. Similar definition is there, but it is prepared by a person to whom who will pay the amount. Okay. Characteristics are not required. Now parties. Here there are only two parties. Generally there are two parties to a promissory note. I am reading on page number 78. Drawer or maker of promissory note generally is the debtor, or pay or person receiving the money generally is the creditor. See, 12,000, shop number 21, Akshat Flat, Bugyandev, Ahmedabad, 21/1/2016. I promise to pay 12,000 only to Sanjay Bhai or as per his order after 2 months from today for the value received to Sanjay Bhai Patel, Ranip Ahmedabad, revenue stamp Suresh Patel. Now what is the difference? In bills of exchange, the person who has to receive the amount, means the creditor, will prepare and he will send the bill to the debtor. Debtor have to accept it. And in promissory note, the person who has to pay the amount will only prepare and he will give the promise to opposite person. Difference is not required. Now on page number 79, bills receivable and bills payable. A bill is mainly known in two ways, bills receivable and bills payable. That two words were in our terminologies also. Okay. A person or trader who has to receive the money from other person or customer draws a bill on that person or customer. The person or customer on whom the bill is drawn accepts the bill. Here it is the bill receivable for a person who draws the bill, and it is bills payable for the person who accepts the bill. In short, the person who is preparing the bill, for him it is a bills receivable, and the person who is accepting the bill, for him it is a bills payable. The next paragraph, a bills receivable is an asset for the drawer of the bill, whereas bills payable is a liability for the drawer or the acceptor of the bill. If the drawer of the bill and the payee both are the same person, then it is a bills receivable for the drawer and bills payable for the acceptor. But when the drawer of the bill and the payee are different person, it is considered to be bills receivable for the holder of the bill. Okay, so this thing is also a general knowledge, that if there are only two persons, then for one him it is a bills payable, for second it is bills receivable. Now if sometimes the third person have to receive that amount, then it will be bills receivable for that third person. Okay, only that much. In balance sheet, bills receivable is shown as current asset, while bills payable is known as current liabilities. Now see, current assets and current liabilities also we know. Assets which have time period for less than 1 year are current assets, and more than 1 year are non-current assets. In the same way, liability also which is payable within 1 year, that is current liability, and more than 1 year, that is non-current liability. The details can be shown in the table format on the next page. Okay. Now this page number 80 is totally important page. Bills receivable, bills payable. It is drawn or made, while bills payable it is accepted. Current asset of the business, so bills payable is current liability for the business. Money is received in future, whereas in bills payable money is paid in future. Generally it is created from credit side, credit sale, and generally it is created from credit purchase. Okay. Now on page number 80, one more topic, term of bill, due date and days of grace. Okay, now that we have seen, the date on which the bill is drawn or written is shown in the bill. It is called date of writing the bill. Underline the whole sentence. The date on which a bill is drawn means a written, that day is known as the date of drawing the bill. Same period is allowed for the payment by the bills drawer to the bill acceptor is called term of bill. So the period which is allowed for paying the amount or for receiving the amount, that term is known as the term of bill. Example, 2 months bill, 3 months bill, etc. After the term of bill acceptor has to pay the amount which is shown in the bill to the bill drawer. So by adding the period of the bill to the date on which the bill is drawn, the due date or maturity date is there. Okay. When a bill is drawn, that is known as date of drawing. When the bill is to be paid, that time period is known as a term, and on which day exactly we have to pay the bill, that is known as due date or maturity date. Example, the date of bill drawn is 21/1/2016, period is 3 months, the due date of the bill is decided as under. How? See, 21/1/16. 3 months are added, so 21/4/16 without days of grace. Now again, what they are explaining about days of grace, in order to facilitate the payment of the money in the transaction of the bill, 3 days of grace are allowed. Underline, 3 days of grace are allowed. This means that these 3 days of grace are added to the date which is derived after adding the period of the bill to the date of drawing of the bill. This additional 3 days is called days of grace. After adding 3 days of grace on maturity due date of the bill, date which is coming is known as maturity date with grace. Okay, so see how they are explaining. 21/1/2016 is the date of drawing. 3 months are added for time period, so it will be 21/4/16 plus 3 days is added for facilitating the payment, so it will be 24/4/16 maturity date, means MD. Okay, maturity date of the bill. If the maturity date of the bill falls on a public holiday or on a Sunday, the preceding day is considered to be maturity date of the bill. So suppose if 24th April is a Sunday, then 23rd April will be considered the date for the payment. And if it is falling on a public holiday such as 26th January, 15th August, then previous day will be considered for the bill. Okay, so you have to remember the bill. Example, if the bill matures on 26th January, 25th January will be considered as the maturity date of the bill because 26th January is a public holiday. Okay, Republic Day. If the payment of the bill cannot be made on the maturity date due to abnormal circumstances like natural calamities, curfew, riots, close down, lockdown, in this situation lockdown is also there, yes, the next working day after the maturity date will be considered. So suppose after 2 days there will be a total lockdown, then if the lockdown is for continuous 7 days, then the 8th day would be considered as the date of payment. Okay. If the term of the bill is given in days instead of months, then number of days should be considered as maturity date. Now see, 21, 160, 90 days is there. Then how they are calculating? See, January 31 minus 21. Why 31 minus 21? The bill is drawn on 21. So that 31 minus 21, 10 days for January, 29 days for February. How? In 2016 it was a leap year. See, leap year will come every 4 years. So suppose in 2020 also it was a leap year. Then before that 2016, before that 2012, before that 2008, before that 2004. All the years are having February 29 days, and excluding all other years are having 28 days for February. So you have to remember that thing also, that in this year leap year is coming or not. Then March 2016 31 days, then April 20 days, because we need total 90 and 70 days was the total. When the sum will come, we will explain it in detail. Okay. Now the next topic, page number 81, bill at sight and bill after date. The main types of bill are as under: bills payable immediately on demand or bill at sight. The acceptor of the bill is required to pay the amount of the bill immediately whenever the person holding the bill demands the payment. Such a bill is known as bill at sight. When you need the payment so much immediately, then we are paying the amount at a time, then that bill is known as bill at sight. Here the acceptor of the bill has to pay the money immediately on the presentation of the bill. A bill in which the payment is not stated also is considered as bill at sight. So if they are not mentioning in the bill that 3 months, 2 months, then you have to pay the bill immediately when the debtor is writing, or sorry, when the creditor is writing. Bills payable after a stipulated period, which we have learned now. The acceptor of the bill is required to pay the amount of the bill after definite or stipulated period. Normally such bill becomes payable in one of the following ways: after the stated date at a definite time, after sight at a definite time, after the occurrence of particular event at a definite time. Since definite period is allowed for the payment of the amount of bill, it is known as bill after dated. So there are two types, where no time period is there and when time period is there. Okay. Now disposal or uses of the bill. Normally there are three parties in a bill: the bill drawer, bill acceptor and the payee. Mostly the drawer of the bill and the receiver of the money, both persons are same. Normally they are same. If there are only two persons, then it is same. When it is a third person, then it becomes somewhat changes. The possession of the bill remains with the drawer or with the holder. The following alternatives are available to a person possessing the bill of the disposal or the use of bill. Each journal entry, we will have different journal entries for it. First we are looking at the names: to keep the bill with oneself up to the maturity date and collect the money on maturity date. Then B, to discount the bill with the bank or a shop before the maturity date, to endorse the bill before the maturity date, to send the bill for collection to a bank or a shop. Explanation is given for each and every one. That thing is not required now because we are having journal entries for it. I will explain in detail how journal entry is written. Now simply I am giving an explanation how these things are there. In detail we don't have to read. First thing is written in A: to keep the bill with oneself up to the maturity date and collect the money on maturity date. What we will do, suppose the bill is of 21/1/2016. Then we are keeping the bill up to 24/4/2016 with oneself, and we are only receiving the money. So there will be only two parties. So normally after a stipulated time, the amount will be paid and received. Next, to discount the bill with the bank or a shop before the maturity date. Now sometimes what happens, we are in a hurry, we need money at a time, but the period of the bill is after 2 months or 3 months. So what we will do, we will go to bank or we will go to a shop. Shop means the person who is giving the money to everyone and taking the interest from them. That person is known as a shop. So we are going to a bank or a shop before the maturity date and we are requesting them to pay the money of the bill, and in the future the person from whom the amount is receivable, that person will pay to them. But now we need the amount before the time. So we have to give some commission, and that commission is known as the discount. Why? Suppose the bill is drawn on 21/1/2016. We need the money in the between. Suppose we need the money on 23rd March 2016. But our amount will be received on 24/4. So if we need the money in between, we can go to the bank or we can go to the store. We will give the bill to them. They will pay the money by charging some discount, because we need the money earlier. So they will charge that commission, and that will be discount for us, and that discount will be our expense, and therefore discount there will be their income. Okay, so before the maturity date we will receive the money, and on the maturity date our debtor will pay the money to them. Okay, so third person will come here to endorse the bill before the maturity date. Here purely third person will come, that B will say to A, you directly pay the money to C on 24/4, and the last to send the bill for collection to the bank or a shop. Means on the maturity date, if we are not collecting the money, and if we are assisting a person on behalf of us, if we are keeping some persons in between, the brokers, for collecting that money, because in business there will not be one bill only. There are so much bills, and we don't have time to collect that bill. So we will give to the bank that you collect the amount on behalf of us, I will give you some commission. Okay, so before the maturity date, the bill will be sent to the bank for collection, and bank will collect the money on maturity date, and bank will credit in our bank account. So these are 4 uses of bill. Journal entries for each we will learn tomorrow. So that's all for today. Thank you so much.